Let's get to the trader rundown now with Joe Teague of Equity Armor Investments. A lot of rock and roll happening in this market. We have a lot to get to here, Joe. So what are your thoughts as we get closer to that jobs report? On Friday, we had the surprise rate cut.
Yeah, we had a lot of data coming out. The market's acting very sensitively to that, so I would expect the market to act on that jobs report. We really want to see if there's any February effect, of course, with the coronavirus. And the market's also just reacting to this surprise rate cut on Tuesday. That was really fascinating to see that. That's really a once-in-a-career type of an event. You don't see that very often. And it was shocking the way the market acted. Actually, we were up before that happened, and then after the surprise announcement, we reversed and finished lower. And that was coming on the heels off of Monday's big rally. So the Monday had a big rally. Tuesday we had a big reversal lower, and the one thing I could say on Tuesday when it looked really bad with this big reversal is that at least we were above Monday's low. We didn't make a new low. Maybe we can set up a double bottom. Maybe we can set up some sort of bottoming formation. On Wednesday we got another rally, and maybe it's because of politics, or maybe it's just because of better corona news, or maybe it's because of better economic news, but the market's just moving around a lot. I don't think anybody can pin any one of those stories on what's going on with the market. I will say the market got above its 200-day moving average, and to me, that's a short-term indicator. I'd like to see it maintain above that 200-day moving average. If it can, then maybe we did see a double bottom on Tuesday. That 200 moving average in the S&P 500 is 30.50. Below there, I think we maintain a short-term negative trend. If we can stay above it, I think that negative trend on the short term turns to neutral. Bond
market. Wow, the Treasury, the 10-year, dipping below 1%. What do you think about that move?
Yeah, bonds at 1% on the 10-year is extremely low, and for me, actually, that sign's a sign of risk. I do not think bonds should be moving this much and these large percentage moves. I think I'd want to stay away from bonds at these levels. I would actually look into dividend stocks, and I'd also, instead of using that tactical allocation where you're long bonds, long equities, I always have liked a hedged equity portfolio. I'm long VIX and long equities that way.
Do you like big household names like a Procter & Gamble, which pays a dividend, maybe a Clorox, for obvious reasons? Lots of people using bleach these days.
I do like Procter & Gamble. I do like consumer non-discretionary names. I think if the market does turn south, if there is a recession, I think those will be some safe haven names. You'll be able to get a better dividend than the bonds, and people are still going to need to go out and buy those everyday items.
Thank you so much, Joe.
Thanks for having me.
For more Business First AM, check us out on social media. We're on Facebook, YouTube, and Twitter. And go to businessfirstam.com for where to see our show on TV.